Ted and Jeff, thanks for joining me today. Let's begin by talking about your careers. So what has been your path in the commercial real estate industry? And most importantly, how did you two start working together?
Sure. First of all, thanks for having me. I've been waiting for a podcast like this to come out for a long time. Something that kind of, is a local thing and also revolves around real estate. So it's good to be on it. My background is I started wanting to be in real estate, construction, architecture, just everything around real estate growing up. And then through college, same thing. And then after college, started at CBRE and was there for about 7 years. And meanwhile at CBRE, I had some friends at Colliers and people that I knew that were trying to get me to come over for quite a while, and finally decided to make that decision and started a new team essentially with Ted, myself, and Andy High doing everything multifamily.
And I actually started at Colliers when I was in law school, so I was a clerk. I took that position my last year of school back in 2011. Stayed on through taking and passing the bar, and then moved into brokerage, actually kind of shadowing a broker who was a friend of mine, or still is a friend of mine, Dave Berglund, and then moved full-time into brokerage that same year. And I think to Jeff's point, I worked with Kevin Doyle, who's now retired. He's a great mentor. As he was preparing to move into retirement, myself and a lot of other brokers were talking to Jeff about possibly moving over because we just thought he'd be a great fit for the climate and just kind of the style at Colliers. Mm-hmm. And it's worked out great so far.
Yeah, it's really good.
That's great. So you guys have mentioned already that you focus on multifamily, correct?
Yep.
Yeah.
Yes.
So how was that done throughout the pandemic? Give me an overview of that.
Surprisingly well. I mean, there was a little bit of a gap at the beginning, January, February, when it first started getting announced that we were going to have a global issue. But we had actually gone out with a couple of projects soon thereafter and didn't really seem to skip a beat. Interest rates stayed low, which helped, and pricing was aggressive. There's still a lot of money to be placed. So it's held up pretty well. Some of the things that were hiccups was really the collections. There's a little bit of a gap between collections in the urban and suburban environment. Urban saw, around 10% not getting collected or vacancies, and suburban was, right around 5%, which is more market. Mm-hmm. So,
and I think we saw too that a lot of clients of ours in March, April, May, they were very pessimistic about even just the mid to long term prospects for recovery. But as we saw a lot of the symptoms kind of alleviate in the summer, in terms of like what Jeff was saying with collections and vacancy, that the market really returned in the fall. So I think we saw a huge uptick in transaction activity as we moved into the third and fourth quarter of last year.
Are there any areas of the metro region where you're really seeing activity picking up right now?
Mainly the suburbs. I mean, in terms of development pipeline, we've done a lot of development work too, whether selling a land site or helping with the equity or working with developers. And particularly the Southwest Light Rail has spurred a lot of new development in the suburbs just in general. Mm-hmm. A couple of years ago, we saw a big rush towards Edina near Southville. And recently is more Opus Park, which is the intersection of Shady Oak Road, 62 and 169 in Minnetonka. And then West End has seen a lot of development over the last 5 years. So from a suburban standpoint, those three markets are really the fastest growing. Richfield's starting to see some growth too. Okay. And then Minneapolis did see a lot, but that was more pre-pandemic, 2015 through 2020.
I think we saw too, expectedly, that downtown suffered quite a bit as the pandemic just lasted on, I should say. I mean, as we got into the later parts of last year and even moving into this year, there's just a number of different factors that are contributing to that submarket still, underperforming relative to previous years. And that goes the same for St. Paul. I think we expect as we move into 2022 that there should be some return to a sense of normality in urban areas. Mm-hmm. As you see some of the employers bring workers back into the office, retail truly opening up, entertainment options being at full capacity. I mean, that's in getting the streetscape kind of enlivened. That'll really drive tenants back into the metro areas, we think.
Yeah, one thing interesting that we've kind of noticed about the suburban markets and even the urban markets too is there's really three groups of renters. There's the straight out of college, want to have a lot of fun renters. There's the single people or couples in their 30s that maybe don't have kids yet. And then there's the retirees too. And the markets that have done the best or will do the best, in my opinion, are the ones that can accommodate all three of those renter types. And if you went through those 4 or 5 nodes that I just mentioned, you know, the average person can probably figure out who wants to live of those groups in those areas. Like West End, for example, can really accommodate all three of those different demographics. And that's why it's seen the most development and been the most sustainable.
Oh, that's interesting. That's a good point. Yeah. Do you think there's going to be growth in those hubs that can hold all of those renters?
Yeah, there's more hubs than what we just mentioned, and it really has to do with walkability in the suburbs, because the people that have been renting for the last 5 or 10 years in urban markets are the ones that are renting the suburban apartments, and they're used to having a walkable lifestyle. And so there's not a lot of places that can really accommodate that. And you can see cities really putting money back into their commercial nodes and downtowns to try to make that happen. But it is difficult, and each site is different. And there's also a capacity issue. Like West End, there's not really many sites left that could be developed. I mean, we're selling one right now that may be the last, you know, theoretically the last site that's there. So.
Oh, wow. Wow. Okay. That's interesting. Great. Well, to pivot back and talk more broadly about the commercial real estate industry, I just wanted to get your take on what sectors of the industry are doing particularly well right now. You know, what do you have your eye on? What are you watching?
Well, the way that the product type is usually divided up is office, industrial, retail, and then there's other, you know, hotels, medical, and some other areas as well. Office has taken a large hit, as you can imagine, from COVID, and then retail as well. And what's happened is most of the money from around the country and from around the world is really flooded away from retail and office and into apartments and industrial. So that's pushed a lot of money and pushed up the pricing on those two assets. But at the same time, real estate is really a supply and demand game. And if there's no new retail being built and no new office being built, I mean, it's going to come back eventually. It's just a matter of how long it's going to take. And I think some of that you'll see converted to different uses. Like we've worked on a couple office buildings that were potentials for converting to multifamily. And we've sold a hotel that was converted to multifamily as well. So some of that is, you know, helping drive down costs on those conversions, but it is a supply and demand game. So eventually everything will come back for sure.
And some of that's healthy too. I think you just see like functional obsolescence in the office and probably in the hospitality space, and a lot of demand in multifamily from a renter perspective. So figuring out ways to preserve some of that real estate and accommodate a new use. I mean, that's just generally good for the real estate market. And I think on the capital side, you see too, a lot of money being redeployed from retail, from office into multifamily and industrial. So there's still a lot of money chasing real estate generally. It's just that it's being moved into different sectors than it might have been previously, or the allocations are a little bit different.
And most of the people, the average listener may not know exactly who owns a lot of the real estate, but a lot of it's funds. Like the example would be a pension fund that a teacher's pension group would have, and they allocate their money into real estate. But from there, they allocate it in different product types. So it's a lot of the same buyers and investors, but they're allocating their money to different product types. And most of them have called and said, we have a lot of allocation towards industrial, multifamily, and increasingly medical office as well. There's guys in our office that do medical office work, and they've said the activity's picked up quite a bit.
That is interesting. That's super interesting. That's something I've noticed myself anecdotally, kind of that interest in medical offices. So interesting you bring that up. So kind of on a similar note here, I wanted to ask about how the pandemic has changed development and design plans. So, you know, what have you observed in that area?
We've heard from developers anecdotally that they've made some modest changes to design, mostly in relation to community spaces or amenities. So, you know, if you have a community room or an office center, maybe it's bifurcated in some sense so that people can work from a small cubicle or office if they're staying home and working in a common space. In a fitness center, maybe the area is not just one big broad open space, it's cut up into pieces so that it could accommodate everybody having their own spacing within the center. But I mean, honestly, I think a lot of that's just to alleviate some concerns with the pandemic and how that plays out over the next 12 to 18 months. But long term, I mean, I'd be surprised if there were generational shifts in how buildings are designed because of the virus. I think it could have some impact based more on people working from home, and if that's sustainable, I think you'd see, you know, unit designs accommodate maybe not an extra bedroom, but a den space or a desk that is off the kitchen that you could put your laptop on, and maybe repurposing or redesigning a community room into an area where people really could work or do conference calls from their personal space. So I think there's a shift, and it probably just accelerated that shift where people are a little bit more mobile and less oriented towards necessarily commuting to the office each day. But I would be surprised if there are major impactful changes in the way buildings are designed just because of the pandemic.
I think the thing that's driving more redesign is actually the renter preferences and the costs. So the renter preferences we've seen is less a move away from like a concierge service when you walk in towards more of a mobile smartphone service. So a lot of the new developments you'll see, you know, the thermostat being run off of the mobile phones, entry systems, cameras. And there's also an increasing number of developments that are around 60 to 100 units. And that's a little bit lower than having a full-time staff on site. And you usually need like 100 to 150 units for a staff on site. And so to run these buildings through more technology is making them more efficient to run. We've seen that a trend. And then on the cost side, lumber costs, concrete costs, steel, everything's going up quite a bit right now. And so redesigning parking specifically, and maybe doing more surface parking as opposed to underground, and or under the building parking, so still first level covered parking, but not digging into the ground. Some of those things are increasingly done to try to save on some of the costs.
And I think too, with technology, that was happening. Like there was definitely a push towards making buildings more automated and less service specific. So I think that was happening, but now that, again, that trend has just accelerated. And I think what a lot of developers are hearing too, or property managers, is that the tenants prefer to have less touch. They don't want a high touch experience. They don't need a property manager or a leasing agent showing them the unit. They don't need to have someone on site for packages delivery. So you're seeing all that become much more automated or done online. And that was brought on because of the pandemic. But I think that's a feature that could sustain itself very well, because it's, I think, for the most part, been successful over the past year.
Yeah, that's a good point. Jeff, you mentioned one thing that I wanted to back up to. So you mentioned that supply prices have been rising. And so how is that playing out in the multifamily sector? How is that impacting, you know, development or buyer interest?
Well, for example, lumber prices have you know, either doubled or tripled in the last year or 2 years, depending on how you look at it. And concrete prices, I don't know, but at least double, steel's double, everything's a lot higher. And so from a development standpoint, it really affects how you're underwriting the future growth in the market. So if you're building an apartment building and the cost to build it is, let's say, $300,000 a unit, that underwriting, you need to have a different type of rent. And so historically we've had good rent growth here, so it's somewhat easy to project out what the next year or two would show. But it's really kind of coming up on that tipping point where it's making it difficult to underwrite projects. And, you know, a lot of the units that are being developed are smaller. So you can, you know, a per square foot number might be higher than what it used to be in terms of the rent. And then, like I mentioned, the underground parking is starting to shift too.
And like the financial feasibility is one part, because it is getting harder and harder to justify building a project without tax increment financing or other assistance from the city. You know, inclusionary zoning, which is a requirement to include affordable units within a project, that dampens returns on new development. So there are, then those are coupled against some of the construction costs rising and just general uncertainty about how much rent growth we'll experience in the short term. So it is getting harder to pencil out projects, and I think you're seeing that with some developers. I mean, we had a conversation last week with a group that closed on a site that we sold to them in February. They were planning to break ground now in May. It looks now like they're going to wait until fall, possibly early next year.
Okay.
Similar experience on a site downtown that we put under contract where that developer prefers to start next year. And a lot of that's driven by some expectation that construction costs will come down as we go into next year, which is not a certainty, but I think there's just a general sense that we could get some response there. And then also just more certainty about how healthy the rental market will be in 2022 and beyond, as opposed to right now. So yeah, there's definitely some pressure points where we wouldn't be surprised to see supply constrained for new developments in the coming years, just based on all the different issues that have been occurring in 2020 and part of this year.
I mean, the larger conversation here is just generally inflation. I mean, there's a lot of people that are betting on inflation is going to continue to happen, and whether this is a long-term issue, or whether this is short-term, more supply chain issue. I think the driving cost for a lot of the lumber and the building materials is heavily on that supply chain side of it. I do think there is a long-term inflation coming. You know, your guess is as good as mine, but short term, it's really that supply chain. So certain developers are kind of waiting to hope that levels out here in the next couple months.
Okay, great. That was interesting. Thanks. So one of my last questions here is just a pretty broad question. Why are people investing in the Twin Cities, and why do they continue to invest in the Twin Cities?
You go with that?
Yeah, I think the two features that, and this goes back to the start of the real estate cycle, if you want to go back to 2011, it's a large number of Fortune 500 companies relative to our population, very educated workforce, and great to good public schools. So I think as you're an investor, whether you're coming from Los Angeles, New York, Miami, Dallas, wherever it might be, internationally possibly, you look at secondary markets, which is how we classify the Twin Cities, and you say, yeah, relative to other secondary markets around the country, specifically other secondary markets in the Midwest, like in Milwaukee, Omaha, Des Moines, those types of submarkets, we stack up great. I mean, we put into our investor prospectuses and investor memorandums a lot of statistics that back that up. And I think even at first glance, to someone that's looking in the Twin Cities for the first time to make an investment, it does trend very well relative to other comparable markets. And then you've got a whole host of other more ancillary factors that kind of drive investor interest, like transit-oriented development, a city or cities around the metro that have been very pro-development or have been, been landlord-friendly to some extent. Stability relative to markets that around the country that fluctuate much more. And Jeff can probably talk more too on some of the other ancillaries on like culture and entertainment and things like that. But it does. We get calls, probably every week or other week from groups looking in the Twin Cities for the first time, and just that base explanation usually gets them somewhat interested.
Yeah, some of the things that the state, in my opinion, the state's done really well at, or the metro in general, is having all the major sports teams here is a big deal. Having international airport that's, I'd say, world renowned is important. Light rail system being built, all those things for these investors, like these institutional investors, they're kind of check boxes that say, check, we have that, we can invest in this market. From there, a lot of it's the culture. I think it's the, like Ted said, the education, family oriented, good place to grow up. Minnesota nice. That's one of the things that people always talk about. It's clearly not the weather, so it's got to be some of those other things.
Definitely not, especially after that long winter.
Honestly, it's often overlooked, and I think part of that is because there's a lot of good, solid local operators and investors here that are already located in Minnesota. So it's really hard for out of Minnesota groups to get here. If you look at who's buying the last 100 properties here, 90% of them plus are either from Minnesota or have already been established here sometime 10 years ago. So we get a lot of times new investors that try to say they're going to enter the market it is, they do, but it is difficult for them to compete with some of the local groups here.
Well, no, I should clarify too, like when Jeff says that most of those or the majority of those investors are either from here or have invested here in the last 10 years. So there are groups, many groups that are bidding on deals that we're selling. They come in second, third, fourth, fifth place and don't win an acquisition. And they're doing that for an extended period of time, sometimes multiple years before they actually break through and finally get their first asset in Minnesota. So it's been very competitive. And I think that's drawing more interest. It's a cycle that benefits owners in Minnesota because you have national investors that are hearing from other national investors that, hey, this is a good market. A lot of people are looking here. It's very competitive, and that kind of breeds its own set of competitiveness. So yeah, I think a lot of that's just through word of mouth with other national investors discussing that amongst each other. Going back to what we were talking about and all the different factors that support investing in Minnesota or the Twin Cities.
Sure. Well, what are your tips or hints for those national investors who are trying to get into the Minnesota real estate market?
You have to pay more. I think the expectations that you're going to come into the Twin Cities and get a good deal or a steal is just not realistic. And in most groups, I think know that now. Probably not if you look back 5 years, where they think that the local market is very closely held and privately held and locally held. And I think, we can get in there and get good deals because these owners don't really know what they're doing. And that's certainly not the case. So I think as investors generally have been more educated, if you want to put it that way, it's understood that this is a very competitive market. And, I think, and we've done a good job to maintain those relationships that, like I said, they might bid on 10 deals for a year, but usually they end up breaking through and buying something.
Yeah, and to add to that, obviously coming in town is the number one most important thing when you're trying to, say you're going to be the buyer on a deal. Showing up in town, talking to all the brokers, having a connection with a local operator or management company, or understanding how you're going to manage the property is a large deal increasingly going forward. I think that's going to be something we're looking at, is who's managing the properties and making sure the real estate that's here is actually running as it should be.
Okay. Well, on a similar note, I wanted to get your thoughts on Blackstone's acquisition last month, and I'll just kind of refresh our listeners on that. So last month, New York-based Blackstone acquired a 22-building portfolio for $247 million. And so I kind of just wanted to get your take on this acquisition. What are your thoughts?
You're talking about the industrial acquisition?
Yeah.
I think part of it is what we were talking about before, where there's a lot of money chasing the few product types that are available. And they are one of the largest, I think they are the largest investor, in, if not the country, the world, for real estate. My guess is what they're trying to do is get into a market and get such a large capacity that they can start dictating what happens in terms of every aspect surrounding the investment. I'm not an expert. There's a guy in our office that actually worked on a transaction, Mark Colesrud, who could answer a lot better. But my understanding of industrial is that it's really driven more on supply and demand than any other product type, because to build an industrial building, there's only certain areas you can do that. There's certain areas the city designates that this can be industrial. And once that's built out, there's really no other land to build out. And once the city reaches a certain capacity to that regard, then I think that it's, pricing has to go up.
I think too, I don't know details in the transaction, but if you just look at the players involved and the fact that Blackstone's making enormous investments in the Twin Cities, that just goes back to the theme of this whole conversation, that these large institutional players, private equity players, are looking at the Twin Cities and trying to make a big footprint in a short period of time. And that's not something you would have seen 10 years ago. So there's been a massive shift from very closely held, privately held local owners to more of an institutional feel. And that has, the landscape's changed drastically during this cycle.
Yeah. To follow up, can an acquisition like this have an impact on the multifamily sector?
I think it puts, the Twin Cities are already on the national investment map, but I think it just backs up that idea, the investment thesis generally, that the Twin Cities is a good place to place funds for real estate investment. So whether it be industrial, office, retail, multifamily, I mean, the product type does matter to some extent, but it's just more generally the idea that we're getting the biggest, largest holders of real estate investing in our market, which just is a testament to how healthy, generally speaking, how healthy the investment market is here.
Okay. Okay, great. Well, that was everything I wanted to ask about today. So is there anything else you wanted to add in or mention?
I guess I would add one thing you asked about kind of what is, what direction the multifamily is going and where it is right now. I think the thing I pay attention to every day is driving in the office. I mean, before COVID, there was congestion to get downtown. And I think that drove some of the living and working rationale for moving downtown. And now during COVID, it's, you can get anywhere in 10 minutes because there's no traffic. So every day I wake up, I wonder if I'm going to run into traffic, and I haven't yet. So it's starting to come though. And that tells me that people are starting to get back to work. And I think eventually that'll liven the downtown experience again.
I think you see too, I mean, the streetscape, we office downtown part-time. So you see like the streetscape still boarded up. Skyways are essentially empty. People aren't meeting for coffee and lunch that much. But if you look at it relative to a month ago, it is changing slowly.
For sure.
So I think a lot of it's just anecdotal, like your personal experience, either driving into downtown or being there. And this, I think there's positive momentum. You can tell that things are starting to change. So
awesome. Awesome. Great. Well, we will leave it on a note of optimism then.
Yeah.
Well, thank you both for joining me. I really appreciate it.
Yeah.
Thank you.
Yeah, thank you.
Great.